Welcome to the Nest Show, the podcast that brings you insights into the crypto market, trading and investment experiences, and what we're looking forward to as we navigate the space together. Before we get started with the show, I want to thank our friends and sponsors over at Prime XBT, where many of our listeners have already signed up to trade by visiting the birbnest.com/PrimeXBT. Prime XBT is the most powerful trading platform offering immediate access to over 30 assets. Users may trade cryptocurrencies, Forex, commodities, stock indices, and much more, all from a single Bitcoin-settled account.
Birb Network is an interoperable DeFi ecosystem offering token pre-sales, staking as a service, project incubation, and much more. Visit thebirbnest.com/Birb.
And now for the show. What the Nest Show is. This is a podcast brought to you by the Birb Nest community, an independent crypto and Forex-centered trading community built to sharpen each other in capturing opportunities in the markets while protecting capital along the way. What this is not. Trading advice. We are not financial advisors, and you should not regard any information here or in the Nest Club as financial advice. You should always consult a licensed financial advisor before making any financial decisions.
Hey everybody, it's Adrian, Crypto Birb here, and welcome to today's very special episode of the Nest Show podcast. And this is a very special episode because we are joined by a very special guest. And I already feel honored and super happy about him joining the show, because that's something that is not usually very typical as far as I recall. And ladies and gentlemen, our amazing guest, the VIP legendary idol, whom I really look up to for a long time already, Bob LOUKAS. Welcome to the show, and how is it going, Bob?
Well, thank you very much. I appreciate that introduction. Certainly, I think not worthy, but I do appreciate that. I'm really happy to be on here with you today.
Awesome. Amazing. And, Bob, you are the trader. You're an entrepreneur. You're an investor. You're especially when it comes to Bitcoin and commodities, for what I know already. You are a commodity to Bitcoin life. You are also the well-known head, for the Financial Tap, right?
Right.
You are the running the service. Is that right? Could you tell me a little bit more about the Financial Tap?
Yeah, the Financial Tap is really how I got started, sort of publicly. I mean, it all kind of started by accident, to be honest with you. It was about 10 years ago. I was very involved with gold. I always have been involved with gold. It's one of my favorite sort of assets to invest in and trade. But I was very involved in a number of forums back in sort of 2008, 2009, when gold was in its secular bull market and doing really well. And, I was commenting on some sort of private forums, and a lot of people just seemed to ask me a lot of questions. Maybe it was the content I was providing. And it just grew from people asking to me actually just producing like this mini PDF letter on the gold market. And it was just something I just enjoyed doing. It was kind of part of my own research and analysis. And then I started sharing that in these communities to people that I would ask. And then all of a sudden I had a lot of people just reach out through friends of friends who had heard about the letter. And it just really grew rapidly and organically to this thing where at one point it was 3,000 people on a list that I had created. And I didn't really have any intentions at that point. It was just something I was producing and sharing. And then it just naturally evolved into a blog. And then from there, people were like, hey, you should be charging for this information. And it never really occurred to me at that point. But I said, well, hey, if thousands of people or hundreds of people like this content and are willing to pay for it, then hey, why not, right? I mean, it's hopefully valuable information for them. So I started doing that, and that was almost 10 years ago now, where the Financial Tap has been running as a weekly letter, mostly covering the equity markets and the precious metals, crude oil, the dollar, for example. And it's just been a forum for me to express my thoughts, my views on the market on a running basis, and just really share my approach to trading and investing, what I'm doing at any given time, and then just help people in general. I mean, it's not a get rich scheme kind of letter. It's just simply how to trade and invest in a logical risk defined manner. And it's just been, I think it's been pretty successful in its 10 years since it launched.
Amazing, amazing. Big congratulations. I mean, 10 years is definitely like a big, just milestone, big number to celebrate. So I'm very happy actually for your success. And, I'm very happy for a couple of reasons that you are today on the show. But those reasons are very personal to me, because you've always been the person whom I've always looked up to, regarding, the financial markets reading. You are
Mhm.
very well known for what is unique in the sphere, for the actual cycle analysis, for the
Right.
cycle theory sort of like application. And as we both know, this is probably the trickiest of them all. This is probably the trickiest, section, the field of the technical analysis of the market reading. Whenever it touches, upon the time, whenever it tries to find some actual structure within the time cycles, well, that's how things are getting pretty much like, just difficult in my opinion.
Right.
So before we sort of like dive into the full details of behind your market reading skills, before your sort of like a favorite principles that you use as an analyst and as a trader, I get a question from you for you. To start with, does technical analysis work at all, in your opinion?
Of course, it absolutely does. I think the problem is that it's not in the sense that everyone believes or expects. And what I mean by that is I think they spend far too much time researching technical analysis, looking for charts, for example, and not enough on the aspects that really matter most in the end, which is, for example, trade and risk management, or my favorite element, which is really the psychology or the human mind or the emotions behind that. So I don't think you could view technical analysis in isolation alone to judge whether or not it works or not, because if you use or judge it by that one simple element, which is, for example, a pattern or whatever analysis you're using alone, then it's open to failure easily. Okay, so but regarding technical analysis more specifically, I think most people believe there's a magic formula out there or a crystal ball, waiting to be found or discovered, and they look at it from that. I mean, that's really not the reality. A lot of noobs on Twitter, for example, somebody will post something and it fails, right? You may post a head and shoulders pattern that fails, and automatically everyone's like, look, technical analysis sucks, it doesn't work. But and that doesn't give it any justice, because technical analysis, in the end, like any sort of strategy, really is only designed to give you an edge. It's a tool to give you a slight edge on the market. But more importantly, further to that, it's really a tool to identify not so much a winning trade versus a losing trade, but to find opportunities that have a very skewed outcome, right? So you can think of it like tossing a coin, for example, where it's 50-50. So you get it right, you win one. You get it wrong, you lose one. But in technical analysis, the goal really is to be happy with a 50-50 type outcome, but to have a situation where if you lose one, but if you win three, right? And that's kind of the whole risk reward concept and principle. But people, they kind of lose that idea, and they just think that, well, it didn't work out, so it must have failed. It's wrong. And I think people get hung up way too much on that aspect of technical analysis and not understanding truly what its design is for.
Yeah, there must be. I couldn't agree more in the first place, but that must be one of the cleanest and the clearest explanation behind TA I've heard in years. So definitely well done. And I can completely agree and relate to what you're saying. Now that I'm getting certified as well as as the committee to this charter market technician association as well. I'm actually on my way to get a CMT free, which is sort of like
Congrats
the
on
final
that. That's
destination.
great. That's a lot of
I
work.
appreciate it. I appreciate that. Yeah, it's a lot of work, but many people ask me like, why do you even do that? Like, what's the point, dude? I mean, and then I just realized, that the further and deeper I go, the better understanding of the market holistically I do have,
Right.
and that's exactly the sort of like switch from this, new point of view that I had, years back, when I would expect a symbol like I draw a line in the chart and I expect the entire world to relate to that, and I expect the entire world to listen, and see what I put in the chart. Like, the truth is, nobody fucking cares about it, right? And those trend lines, trend lines are just the lines that show the trend direction, nothing else. And occasionally people tend to place their supports and resistances, sort of like anticipations, the bids and asks, around that. That's it, right? So there's nothing really magical or sorcery in that, as many people would expect, just like you perfectly mentioned. But the TA, completely agree, is supposed to give you the edge, right? And well, while this actual sort of like coin tossing, is more of a random walk when this is just kind of like a 50-50 chances. I remember having this conversation, which is important and significant and intriguing, with a professor at the University of economics in my country, in my town, and he was like, technical analysis doesn't work because it has 50% chances it goes up or down, right?
Right.
And I was like, okay, dude really is a professor, but he really has no clue about what he's just saying, right?
Right.
And like, this would negate the entire existence of trends and cycles. But the trends and cycles, they do exist, and apparently, based on the scientific research and the statistics and the actual practice, the technical analysis actually can give you the edge and can make you profitable and make your profitability at a better rate at the entire market, for the index performance, for example, is right to give you the edge of the market.
Absolutely.
But I'm with all that said, we as traders, we always need to pretty much like search for our own edge, for what makes us better than the rest of the market, right?
Yes.
What makes us read the markets the better, faster, and react to that better and faster. And in your very case, it does seem to me that a big participation in that edge, comes from the cycle theory. Is that correct? Could you shed some more light on that?
Yeah, absolutely. I mean, and I think you touched on a very important point. I get the question, and before I go to cycles, I'll just mention something around strategies that work for people. Strategies in general, regardless of what that strategy might be, I find is very personal, and people resonate personally with certain strategies and don't with others. And I get the question a lot. Well, what should I read about cycles, or what should I read about this or that? And, what should I learn? And I always say, just try and get a broad sense for all the sort of strategies that are out there, and try and work out what you understand best and what resonates with you and what you kind of get. Because in the end, it's almost like an artistic form in some ways, where you have to like it and you have to feel it and sense it to appreciate it and to study it and to do well in it. And for cycles, that was for me, right? When I discovered cycles, Walter Broussard, in the 2000s decade there, it just made sense to me. It just made a lot of sense. And I just loved the concept behind it and the reading of it. And I took to it for that reason, right? And I mean, I think, again, back to your point, you can be successful with almost any strategy as long as you adhere to it and you follow the fundamental rules of that strategy. And again, before I touch on cycles, one other point about sort of technical analysis in general, you have to take the good and the bad. I mean, some strategies will work best in different environments, and they won't work too well in other environments. And if you just take a broad stroke and say, well, it's always got to work in every environment, then you're setting yourself up for failure, right? You have to know where your strategy is, what is good and works well. And then those environments, you push the pedal to the metal and you trade it aggressively and confidently. And then in an environment when your type of strategy is weaker, you have to pull back and you have to acknowledge and you have to appreciate that now is not the best time in this given environment where my strategy is going to do well. And you have to acknowledge that. And I think that's very important. But with cycles, and like cycles, for example, have certain times and points when they are weak and they're not clear. And if you try and force your understanding of where we are in a certain cycle or what a cycle might be doing in an environment like that, you're setting yourself up for consistent, possibly losses and failure. But when an environment is trending really well and the cycles are clear, which means the pattern of time and price and sentiment really align well. And you see that sort of in Bitcoin, when what Bitcoin's doing right now, for example, what gold did from August of 2018 to 2020, or what gold did in sort of the decade of the 2000s. When you see clear bullish cycles occurring, then they work really, really well in general.
Yeah.
So I'm not sure if that really answers your question specifically on cycles, but that's something, that's just how I gravitated towards those. It's something that made a lot of sense. But, cycles in general, if you want a little bit more of a background on those, they really represent sentiment, right? Sentiment over time. And they represent kind of the collective ecosystem of an asset class. It's participants. It's participants almost collectively. That's like a network effect. And they have swings in sentiment. And that swing in sentiment is repetitive over time, kind of like the seasons, right? And interstellar and planetary movements, they work on cycles. They're predictable. They're not always perfect, but they can be very predictable, and their ebbs and their flows over time, if you can identify them and see the patterns, they give you a predictive edge in the future where you can say, okay, well, we've had this last few cycles have been like this, then there's a good chance the next one will be like that. Of course.
So what you're trying to say is that you're reading horoscopes and you base your trades based on that.
Exactly. Sometimes a lot of this stuff is right. Actually, there are some people that make some money on the astrology and so on.
I know. I've seen it.
Yeah. I mean, it's not for me, but again, there are strategies that work as long as you can adhere to the principles. And cycle theory certainly has some principles, but cycle theory is also open to a lot of interpretation. A little bit like Elliott wave, although Elliott wave is a little more hard count based. Cycles, it's like sitting on the ocean or sitting by the beach and looking at the waves roll in, right? And for 20 minutes, you'll see waves come in at a sort of very low frequency, maybe, or just half a foot, 1 foot waves, and all of a sudden you'll get a patch of an hour of high waves. So the preceding wave is an indicator of the wave to come, but what happened an hour or 2 hours ago may not be, right? Or if there's a storm that's coming and the storm's going to last for 4 hours, then for 4 hours you're going to see a series of larger waves come through. So if you understand what the larger or the longer wave cycles are doing, in which direction they're trending, then you can start breaking it down to lower time frames and start to predict that those waves will mirror the longer waves and the longer cycles. So it's understanding where you stand kind of in a secular trend and then breaking it down from there. So if you're in a secular bull market, then the lower time frame cycles are most likely going to be what we call right translated, and they're going to be rising cycles. And in the bear market's the same, it's the opposite. In a declining market, you get these pumps. They're very short-lived. They're normally just regressions back to a mean or declining mean, and then you get the majority of the cycle turning over and moving lower below the prior cycle. And it's just this repetitive cycle and this repetitive nature. Of course, every cycle, longer cycle, comes to an end at some point, and that's where it's sometimes difficult to predict when does a longer cycle come to an end, because when it does come to an end, you're looking potentially at a full reversal. When a bear market ends and you start a new bull market, then it kind of flips on itself, and that's where maybe it can become a little challenging.
Yeah, I think you well, Dame, I didn't want to interrupt because you depict all of that, in such a beautiful and passionate way that it's actually very pleasant to hear you talk about it. I mean, it's pretty amazing.
Yeah,
I can easily tell that you're very inspired about it.
Well, I warned you I would ramble on a little bit, so you have to interrupt if I go on too much.
No way, mate. That's definitely big stuff that you're talking about. And regarding the cycle theory, there are a couple sort of like main principles, like the overall cyclicality, that it exists, that the financial markets, they're composed of cycles, or the harmonicity, that you would see many sort of like different bigger and smaller cycles being very often like multiplications, of twos and threes of the sizes of those cycles. you see also the summation, sort of like a principle that all those cycles, the smaller cycles and the bigger cycles, they tend to summate, and they tend to present you with some composite waves. Or the synchronicity, that the biggest market sort of like movements, the biggest swings, the bear markets, bull markets, the secular bull markets, bear markets, they all happen sort of like in tandem for those sort of like smaller cycles. Just like proportionality, nominality, variation, that for example, all the markets would never be perfect and ideal, right? Surprise to many people.
Right.
Because everybody would perfectly, just always anticipate the perfection and ideals in the world, but they never come, right? Which is often a big surprise on the negative aspect. But all of those cycle principles, I got to be honest with you, it's extremely intriguing and impressive to what extent they actually work. This set of like you said, be it the seasonality effect or the actual sort of like a sentiment fluctuations over the years and across all the time frames. That's the sort of like what we call the fractal nature for those who are listening and are new here to the show.
Yep.
It just makes it so impressive. It is like a element of a big puzzle that when you match the cycle analysis, when you match the cycle theory into your overall market rating, all of a sudden this makes it a complete sort of like a complete puzzle solved. And I just very quickly want to touch upon that because I believe that's what's going to matter very much right now in the next months and years, about the commodity cycles. I'm referring to an actual chart. I can actually just display that very quickly.
Yeah, sure.
I'm actually corresponding. I'm referring to the commodity chart, to the commodity index, Bloomberg Commodity Index.
Right.
For those who are actually again just less, let's say, acquainted with the technical analysis itself, we are looking at the actual 50-month average in here and the price action, for the futures index. For the index futures for the Bloomberg Commodity Index. Now we are seeing that the price breaking out on the monthly scale, on the monthly time frame, above the 50-month average. So, like it or not, in my opinion, it looks like a start of a very beautiful journey and story to come within the next couple of years.
Right.
What do you think about commodities for the next years?
Well, I thought back in 16, when you look at that low, we were probably looking at the start of a new cycle, a new secular cycle in commodities. I don't track any of the commodities from a cycle standpoint. I tend to focus on 3 or 4 very specific cycles and just trade those as to my best of my ability. But I definitely think we are well overdue for the start of a new commodity cycle, a bull commodity cycle. There's no doubt about that. As well as some emerging markets as well, which could go hand in hand to some extent with the commodity cycle. But we don't have that confirmation just yet. I think you're starting to see some of that early sign there, possibly sort of a final shakeout there in 2020 before beginning higher. But absolutely would agree with you. We are probably well overdue for that. Now, of course, a lot of outside factors and influences as well in financial markets. But I think I think you're on the right track there with that and would agree.
Awesome. I mean, the commodities are actually very much correlated with the dollar, right? And with the overall monetary policy from the Fed, of course,
Yep.
from the global government sort of like as well, because the truth is that all of the commodity sort of like markets across all the planet, they all sort of like work in the same direction. All of the markets, they tend to move globally, right? This is sort of like one of the principles of the intermarket analysis, which tells you that all of the markets across the planet, be it for the equities, for the stocks, for the commodities, for the interest rates, inflation, and so on, those are the global secular trends to some extent. And commodities are strongly correlated with strongly combined, they are strongly correlated with the inflation, with the dollar strength as well in between. And what information do you think, the potential commodity sort of like a breakout in future may bring for the inflation, for the equities, Like, what would you say if that's not a secret, of course? What would you say is the future within the next couple of years going to look like regarding commodities, equities, the interest rates, perhaps as well, the
Yeah, I
bonds?
mean,
What
I
would you
have
say?
I have my views on equities. I can definitely share a lot on that. In terms of commodities, I think a lot of these assets, these hard assets that take, significant investment to pull out of the ground into mine. I mean, I think a lot of them are significantly undervalued, and I think, as you point out, are probably now in the early stages of the next sort of cycle. We also, though, have globalization that's playing a major role in keeping sort of prices down in general. So, and also the sort of innovation as well. Being able to extract cheaper or finding more richer sources here and there across all the commodity space, I think is keeping, to some extent, sort of prices sort of compressed a little bit here. But I think that is, I think real inflation is still a thing, and you're going to start to see that reflected in commodity prices overall. I mean, we're looking at crude oil already up towards $60 a barrel now. Copper is also making some significant moves. So we're starting to see that now across the board. I think it's the start of a new sort of secular wave that's coming on board. Now, stocks, equities, that's a tough one, because we really are 12 years into a pretty significant sort of secular bull market. And more so in the US than I think in a lot of other places. I think emerging markets are going to be a great place if you're patient. I mean, that's something I've been looking at for 4 to 5 years. It hasn't really moved yet. It's kind of been sitting at that 10-year level where it wants to break out and sort of start a new trend. And I think it will for those who are very patient. But the S&P, for example, or the NASDAQ, of course, the Qs, secular bull market that, by any stretch or historically valuation-wise seems very high. It seems like fundamentals don't really matter anymore, and fundamentals generally don't matter towards the tail end of a secular bull market. Right? We tend to throw away.
You sound like Dave Portnoy right now.
Right. Yeah, I'm not sure about if I believe a lot of the principles. I mean, he's obviously a speculator, and he trades price. He trades price, which is really the way to look at it. And I agree. Look, the show will end at some point, and there'll be a rush for the exits. And we've had many of those, and you can see on the chart that you're showing right now. We get these 20 and 30% swings, but the market quickly retraces and continues that trend. So the secular trend is still up. And if you look over the last 100 years, we do see bull markets typically go to 16 to 18 years. Before a peak. And we're around 12 or 13 years into this one with a very accommodating Fed. Interest rates play a pretty big role in the equity markets, right? I mean, being able to access capital at very low rates is obviously very beneficial. And not only in the US, but worldwide, the accommodating nature of fiscal policy is significantly flooding the market with cash. Demand, artificially pumping up demand. I mean, all these stimulus checks, right? They're going straight to Walmart. They're going straight to Home Depot or people's vacations, whatever you want to call it, which is obviously flowing back into the markets, and that's goosing the markets up. And this is what's driving these markets. So I think the best way to view equity markets is not from a fear perspective, which keeps people sidelined and away from the markets out of fear, but just simply to say, look at the trend. I mean, look at the price. If you sat here in 2013, 14, 15, 16, worried about the overvaluation or worried about a crash, then you've missed.
They would really want to short that, right?
Right. I mean, shorting. Shorting obviously is just. Shorting this bull market is just simply just ridiculous. I mean,
hating
there's just no. Yeah. I mean, that's just like, just might as well just piss away your money, right? But being out of the market as well is that opportunity cost, sitting in something else when you have this opportunity ahead. Of course, it will turn, and there will be opportunities to identify a bear market, and you'll have to give up the top 30 or 40% of that move, maybe, right? Or maybe not that much, of course, but you'll have to give up, some of that to identify it. But when you've got a trend like this, you have to, and this is where I like cycles, where if the trend is cycling, if it's cycling in one direction, then there's a pretty good chance the next one's going to be the same. Right? And at some point it will turn on you, but preceding action and the direction of the market and the trend is almost always a very good indicator of where the market is going and wants to go in the future. And again, you have to put that fear aside, and you have to have a little bit of faith. And of course, you have to adhere to risk management principles. If you leverage yourself up and you option yourself up, then of course, any swing, short or intermediate, can really throw you off. But overall, if you keep it reasonable and allocated, you should do well. And I think that's going to continue in the equity market for a little longer. I think a lot of this decade still might be a massive sort of big blow off in the equity markets in general. I think that's still very possible.
Yeah, I think that you shared, you shared what many people hate to hear, because apparently shorting is just one big scam in the stock market, right? And let's actually just give a very quick launch, to the simple moving average. Let's say 200, right? The simplest way for those who are listening and viewing the chart, actually, as I am right now, the simplest way to decide about the trend direction is to analyze the price on the average. Well, so you can pull up the MA200, the simple MA200, and it's going to tell you 200 weeks on average price is increasing, right? Since the very sort of like 2012. So that's the main information. And the question is, do we really want to counter trade the trend, right? Do we really want to short it, knowing that shorts itself, on the stocks, well, shorts provide you with limited downside on the opposite edge, on the opposite sort of like a side to the longs, which provide the unlimited upside in theory. And now that the governments are on the side of the people who long, actually, right? They keep printing money. They keep pretty much like flooding the market with the money, the helicopter money. There is of course this sort of like a case of money velocity. The M2 money aggregate velocity, for example, within the market, that is still has to do with the inflation control. But betting against stocks right now is betting against the governments and the bank and against the banks who are printing money on demand. So it could never work well simply in the longer period, right?
Right.
It's sort of like destined for the loss. And again, go ahead.
No, I mean, you're touching on a point where why short? I think when people short something like equity markets and the stock and a bull market of this nature, they're not really looking to profit from a short. They're trying to kind of validate, a narrative that they've developed in their mind, whether it's some type of conspiracy or some type of just they're taking these sort of old fundamental principles and kind of just making these, forming these narratives that the market should be doing something. And I think they're just trying to reinforce that they can be right on something. And that's this tendency for novice investors and traders to look for picking bottoms, in a bear market, or picking tops in a bull market. There's a sense of sort of worth or accomplishment maybe by being able to pick something like that, which obviously doesn't work all that often. Sometimes it does, and it feels great, apparently, and maybe there's some clout to be had from doing that. But in principle, picking a reversal in the market that has given you no reason from a price action perspective to believe that is really a losing proposition. And I think people just are drawn to wanting to do that, but it doesn't really work too well in the end.
Yeah, and on top of it, whenever they are wrong, they can just admit that technical analysis doesn't work, so they are covered one way or another.
right.
So they don't need to worry about it. I'm talking about the speaking of the betting against the Fed. Speaking about finding the tape, as they say. We have been looking, for some time at the actual impacts and the effects of having the largest ever sort of like just increase over the money stock just being poured into the market by the government, of course. by the Fed. But here, it just tells you that about 30%, I cannot recall the exact number, like 27 or 30% between those of the entire ever printed money, was printed actually within 2020 alone. And we as traders, we as analysts, we always need to pay the biggest attention towards actually the biggest, right? Because this brings the biggest sort of like impact, the biggest weight, of course, and the biggest significance. So speaking of it, I think it just tells us a lot about the overall direction for the next couple of years regarding the overall sort of like inflationary, I should say, anticipation or plans, and it just sends a clear message to me. There's of course there is no doubt that most of the people don't really know what's going on the planet, right? They don't know what's going on in the finance, because as long as they get the $1,000 check or the stimulus, they're fine because they get it. But nobody ever wonders whether or not this check is worth the same as it used to be, for example, as it used to be worth 1 year ago. And apparently, over the time, those checks, decrease in the real value because of the inflation, right? And this inflation is like a hidden tax very often that we pay unconsciously. And speaking of the next years, because this, as I said, this market reading tells us about the potential sort of like Fed ideas of what the monetary policy is going to look like. That is going to be very easy. That Joe Biden already said and admitted that they are going to pretty much like print as much money as they need. And what does it tell us for the next years? Like, what is the sort of like plan of Bob LOUKAS to prepare and to prevent from losses for the next years?
Well, I mean, what it does say is that we're in a secular environment now where the powers to be can allow this to fail, right? And asset prices are a big part of personal wealth, and they need to protect that as much as possible. And there's also the concept of MMT. You've got universal basic income kind of gaining momentum. The idea that deficits really don't matter at all is gaining a lot of popularity. So I just don't see how they can allow this party to end in general. So this means, yes, from a real perspective, from a real rate perspective, you're looking at devaluation in sort of fiat or currencies in general. Is it Armageddon? Is it sort of wheelbarrows full of dollars buying a loaf of bread? No, I don't think so. I don't subscribe to any of that. I think in general, the world now is sort of coordinated in sort of devaluing their currencies in general. And you'll see this reflected in hard assets. Obviously, Bitcoin is an example. Gold is probably a better example because it has an established intrinsic value, and you'll see it reflected there. I think Bitcoin in general is not rising because the dollar is falling, even though people on Twitter love to talk about the dollar fell, so Bitcoin's up. No, I mean Bitcoin's finding it's in price discovery mode and finding its value.
There's more to do, yeah.
Yeah, so it's really about Bitcoin going up, whereas dollar down. But gold is a better reflection of that, and other hard assets as well. I mean, look at real estate around the world and land prices, for example.
Bill Gates.
Yeah, and I think there's just going to be more and more of that. Asset price, continue to expand rapidly. So you want to be invested in these hard assets. You want to have assets that you can own, that can't be confiscated, that can't be taken, that you have title to, that you have a deed to. And I think as long as you have those assets, you, at least if we're talking about inflation, you're protected, right? Because whatever inflation we see will be reflected in the prices of those assets. So in terms of like my plan or my plan specifically, well, I mean, I've already reached a point where, I'm more in, I wouldn't call it sort of defensive mode or protection mode, but, I'm just gonna be perfectly honest. I mean, I've made what I need to
retired.
Make. Yeah. I mean, I'm doing a lot of what I'm doing out of passion, and, just out of enjoyment more than anything else. And I live a fairly realistic existence in general. I don't drive fast cars. I don't like big flashy homes. I have what I consider to be a nice home here in New York City. And, and I kind of rent what I need wherever I want to go. I'm not into owning multiple, I'm not into spending a lot of money for the sake of sort of showing that I'm content with what I have. So I don't need a lot is what I'm saying. And I don't have an interest in building a dynasty for my children necessarily. I think they can work for it like I did, and like my parents did as immigrants who went to Australia with nothing, and besides a small bag of clothes and the promise of a new job, a new future and a job. So just to that point, it's more just about protecting what I have, and hard assets I think provides that, while at the same time looking for these, that's what Bitcoin attracted me to, finding these sort of asymmetrical, really skewed asymmetrical opportunities where I can risk enough where it doesn't hurt me if I'm wrong, but really be rewarding if I'm right. And I think that's really the approach in general, even for somebody that's sort of not set. I think in general, not looking for the next big thing, always constantly, the feeds on social media and jumping in and out of things, and just taking it much, much slower and finding setups that really resonate with your style and executing perfectly on those is way more important. And that goes from a trading standpoint, but also from an investing standpoint. Just being really patient in general and making decisions on your own terms. I like to say that a lot on Twitter and in my private service. You really have to pull the trigger when you want to pull the trigger, and not feel compelled to do so for other external factors and sources. And I think that's very important to success.
What a beautiful way to say I'm aging. I'm getting old.
I'm aging,
Yeah.
right? Yeah. I mean, look, we all learn from experience, really. And, I've blown accounts in my 20s on the dot-com bubble. I've made a lot of mistakes, and I still make a lot of mistakes. And a lot of what I do doesn't always work. But I just don't let it hurt me as much as possible. And I do it most of the times looking back saying, I probably wouldn't have done too much different as well. And I think that's the place you want to kind of get to.
Exactly. I can perfectly confirm that, although I'm definitely, just not as experienced as you are. And that's what I've, as I said, for all your insights that you actually share, I value so much. First of all, the fact of your being here, but also for all the tips that you're sharing, for the younger generations, because many people, after hearing, your thoughts, are probably going to get converted to actual saying, what matters in the money. And what matters in the money is not endless increasing the risk. It's not endless, just buying and searching and waiting for the next 100x leverage sort of like position, right? Or over the time, as long as your equity also curve goes up, the less risk you need. And actually, the more protective mode you need over your portfolio, because 10% slide, for example, of 1 billion is going to cost you 100 billion, right? So those are the big money that you're actually losing when the market proves you wrong. So the bigger money involved, the more actually sort of like control over the risk there needs to be. So I perfectly understand what you are sharing. And this is a very strong and powerful message that I also want to, just resonate well with all the viewers and listeners. So knowing of your sort of like experience, Bob, and what you've been sharing recently about crude oil, about the commodities as a whole, about gold, could you give us a very quick notes and message about silver? What do you think about silver?
Well, so silver so I think gold is a few years now into its next secular bull market run. I think it's pausing here and could consolidate for most of the year. Silver is at that phase in the gold bull market where it's now going to begin to play a little catch up. And we've seen this in other bull markets for gold, where the primary asset in an asset class at the beginning of a bull market will typically get the lion's share of the inflow, the capital that comes in, and the accumulation begins there. And then what happens is when that price appreciates and gets a little ahead of itself, new entrants that come in are not as sophisticated, and they start to say, well, it's already overpriced, it's already gone up so much, but what about the cousin, right? And we see this also in crypto, where sort of Bitcoin makes its run, and then the dominance begins to fall at the latter part of a bull market, where people start to look for more speculative names. And we're in a similar sort of point now in the gold silver sort of ratio, where it's beginning to come down. And silver, I believe, will dramatically outperform gold now over the next few years, and may also in the short term in 2021 decouple from gold. So I can see gold possibly moving sideways, or mostly trending sideways this year, while silver detaches and begins to make a run, because it's still a double away from its all-time high that was set a decade ago. And that same level was set obviously with the Hunt brothers back 40 years ago now. So it has a lot of room to play and a lot of catch up. And I've been talking about silver on Twitter, obviously my Financial Tap service as well, for a couple of years. But ever since it flushed out in March last year, I think that is the start of its next trend. And I think it can hit and make a run to 50 over the next probably 2 weekly cycles, which is a year to maybe 18 months. I think it's going to make a move like that. So I'm bullish on silver. And I think there's opportunity there for sure.
Amazing. I'm well invested in silver. I'm actually planning to equip myself with a bit more of silver as the next day's show, hopefully. Same with gold. I definitely just know what we know for sure about silver is that it moves rarely, but when it moves very fast, and
Yes.
it moves very strong, right? And
Yes.
when it pumps, it really behaves like this sort of like cryptocurrencies, on steroids as well.
It does.
And
Yes.
and especially those 2010, 11, the peak, the 2012 confirmation, whatever, to the bear market on silver, and that it lasted until 2015, when it started actually just going sideways for a couple of years, for 6-7 years. I mean, this was all going and happening when the dollar was actually much stronger than it is right now today. And by the dollar, I mean the actual value, the actual sort of like aggregated inflation over the time. We know perfectly, just like you said, that dollar over the last 100 years, it lost like about 95% of the entire sort of like buying power, right? That's the real measure of the inflation as well. And knowing that this is a direction, the big influx of demand can actually spike up the price very fast on silver. And you never know when it comes, unless you are Bob Lucas and you are master, with cycle theory. But the main message that I also want to equip people with is, guys, you don't need to go for 100x. You don't need to learn and pretty much like learn only about what gives you 10x positions, what gives you 10x in a day or in a week or in a month. Hard assets like Bob and I shared are apparently the ones that are going to matter more and more over the time. Just look at what Bill Gates just did, right? I may not necessarily, just agree with his overall personal beliefs and the directions and what he's doing, but from the investment point of view, we need to copy pretty much like what Big Money does, right? And he just became officially the largest landowner, right? A farm landowner in US, as far as I recall. And hard assets, this is going to matter within the next years. Mm-hmm. So apparently, I want to sort of like leave all of our viewers and listeners with following the custom that we always have on the Nest show. And Bob, this is your place right now, if you will, if it's not a secret, of course, of the master tip, of the final thought, the final most important tip, the takeaway message that you would like to leave our listeners with.
God, you're putting me on the spot here. Yeah, I mean, it all depends on sort of where you are. Let me think about this. I think just in general, psychology in trading is the one area where it's probably the biggest lever, of performance that is underappreciated and utilized. And it's probably the last thing that I began to really focus on through more sort of stoic reading and so on. But I think just, who you are behind that keyboard and that mouse and what you're feeling and what you're doing and the actions you're making and why you're making certain actions at certain times is lost on most traders, because they're in the thick of things. They don't sort of divorce themselves from the action, and they think kind of with their emotions, or they act with their emotions as opposed to acting to any sort of plan. And that's because often, they're doing it for maybe the wrong reasons, whether they're, addicted to the action and the adrenaline. But just in general, I mean, that's a long way of sort of saying you just need to know yourself a little more and focus more on the elements of psychology and emotions in trading. I think that's a big part of where a lot of alpha are sort of left on the table, and where a lot of the mistakes come from. Look, any trader listening to this, or anybody that's investing who listens to this, could probably agree that all of their mistakes were probably made because they acted in the heat of the moment and made some really poor decisions that cost them significantly. And they weren't because they picked the wrong chart or the wrong, the wrong strategy. It's because they made a mental error and a mental mistake. And I think that's probably it, if I had to sort of say one thing.
I love it. I love it. Those are beautiful words. Those are very important words. We can also wrap it, under sort of like finding your own strength. If I read well what you shared, learning about your strengths and weaknesses, and actually learning about the behavioral finance, the behavioral psychology, what makes you follow the perception biases, right?
Yeah.
And
yes. Yeah.
This must have been probably one of the best podcasts I've ever had. One of the best educational sort of like materials and component for a lot of people who are going to listen to that. So with having said that, I truly want to appreciate your time generosity, your wealth, sort of like of knowledge that you are just sharing with us today. And ladies and gentlemen, what can I say more? Trader, entrepreneur, investor, committed to Bitcoin life, and the head of the Financial Tab, Bob LOUKAS, has been our guest today. Thank you for coming over. It was a pleasure.
Thank you for your time, and thank you to your listeners. I wish you all the very best, and I do appreciate your time.
Amazing. Until the next one, guys. Cheers.
Globe is an upcoming crypto derivatives exchange offering up to 100 times leverage on crypto and DeFi perpetual contracts. Sign up for early rewards at thebirbnest.com/globe. DeFi Click democratizes the lending market by offering both collateralized and uncollateralized loans to everyone with cross-chain interoperability through Polkadot. For more information, visit thebirbnest.com/DeFi Click.
I'd like to thank our listeners for joining this episode of The Nest Show. If you've appreciated the depth and breadth of what you've heard with us today, subscribe to our podcast and find our landing page at thebirbnest.com. We have a vibrant Discord community which acts as our central hub of operations, and we welcome you to join us at thebirbnest.com/Discord. We also offer an extensive free bulletin on emerging crypto market trends, exclusive undervalued gem reports, and in-depth expert technical and fundamental analysis at thebirbnest.com/bulletin. We always appreciate engagement from our community, which of course means liking the video and subscribing to our page, where we insist on bringing you the highest quality content available. Also, we're happy to incorporate tips and topics from our listeners and encourage you to email us at thenestshow@thebirbnest.com. This podcast is brought to you by the Birb Nest. Thank you, and trade on.